Hello, everyone, and welcome to this deep dive into Module 12 of our financial modeling series. This is your course administrator for the SNB Experts training platform. Today, we are focusing on a subject that separates the amateurs from the professionals: scenario, sensitivity, and stress testing. In the real world, a financial model is only as good as the tests it survives. We aren't just building spreadsheets for a perfect world. We are building tools for a world full of uncertainty, market shifts, and unexpected shocks. In this session, we will go far beyond basic formulas. We will learn how to structure a narrative for your data, identify the hidden levers that drive business value, and ensure your models provide a true safety net for decision makers. This is where your analysis becomes truly strategic. Let's begin our journey into mastering uncertainty. Our learning objectives today are designed to give you a complete toolkit for risk analysis. We will start by mastering the scenario analysis framework, learning how to define base, upside, and downside cases that tell a consistent story. Then, we'll dive into the technical side, mastering Excel data tables for two-way sensitivity analysis. We will also learn how to create and interpret tornado charts, an essential tool for summarizing complex sensitivities into a single, high-impact visual. From there, we'll explore risk mitigation through break-even analysis and goal-seek. For those looking to push their skills further, we'll introduce the foundations of Monte Carlo simulations and probabilistic modeling. Finally, we'll look at the rigorous world of stress testing, preparing your models for the most extreme economic conditions. This is a comprehensive agenda, so let's take it step by step. Before we touch a single cell in Excel, we must understand the conceptual foundation. Scenario analysis is about more than just numbers. It's about strategic foresight. Why do we need a framework? Because a single-point forecast is, by definition, almost always going to be incorrect. By defining a range of possible futures, we allow management to visualize different paths the business might take. A structured framework ensures that our assumptions aren't just random guesses, but are instead part of a logical, coherent narrative about the external environment. This narrative approach helps turn raw data into actionable intelligence. It's about moving from what happened to what could happen and how do we prepare. Let's look at how we typically structure these possibilities. In a professional setting, a scenario framework typically consists of four main cases. The base case is our baseline, reflecting current trends with a 50 to 60% probability. The upside and downside cases, each at roughly 15 to 25%, represent optimistic and pessimistic departures from that baseline. But look closely at the severe stress case. Though it only has a 1 to 5% probability, it is perhaps the most important for risk management. It asks, what happens if everything goes wrong at once? By assigning these probabilities up front, we force ourselves to think critically about the likelihood of different outcomes, ensuring that our final analysis is grounded in a realistic assessment of risk. This transparency is crucial for building trust with your stakeholders. To see this framework in action, consider this retail business case study. Notice the relationship between variables. In our base case, we expect 8% growth. If we move to an upside, we anticipate 15%. But if we move to a downside, growth drops to 2%. Crucially, these variables don't move in isolation. In a downside scenario, if revenue growth is low, it's highly likely that customer retention is also suffering, perhaps dropping to 60%, and our store expansion plans would naturally slow down. This is what we call internal consistency. A good modeler knows that if sales are up, costs might be up too. Your scenarios must tell a story where all the parts move together in a way that makes sense. This level of detail is what makes your financial model a true reflection of the business reality. With scenarios, we've painted a broad picture. Now let's pick up the scalpel and look at sensitivity analysis. While scenarios change many things at once, sensitivity analysis isolates individual variables to see how much each one, on its own, impacts our results. Think of it as stress testing the sensitive parts of your model. For instance, if you change your discount rate by just 0.5%, does your project still make sense? Or if your cost of goods sold increases by 2%, does your margin collapse? Identifying these critical points is vital because it tells you where you need the most accurate data. In Excel, we have specialized tools called data tables that make this complex calculation look easy. Let's see how they work. The Excel data table is your best friend for sensitivity analysis. A one-way data table tests one variable against a range of outcomes. But the real power comes with the two-way data table, where you can see the interaction between two variables simultaneously. Imagine seeing how your NPV changes as both your growth rate and your interest rates move. To set this up, you'll go to the Data tab, then What If Analysis, and select Data Table. You specify which cell in your model corresponds to the row input and which to the column input. Excel then runs all the calculations for you in the background. It's clean, it's efficient, and most importantly, it's dynamic. If you change a single assumption elsewhere in your model, the entire table updates instantly. This is a hallmark of a professional-grade financial model. Let's look at a practical example. Testing the sensitivity of net present value to changes in WACC and revenue growth. This matrix shows the NPV at every combination of these two variables. But what makes this truly useful for a presentation is conditional formatting. By applying a color scale, we can immediately see the green zone where the project is highly profitable and the red zone where it becomes a risk. For example, even with a high 12% cost of capital, if we can achieve 12% growth, our NPV remains strong at $34.5 million. However, if growth falls to 6% at that same cost of capital, we're in trouble. This visual transparency helps you communicate risks to management clearly and effectively. It shows them exactly where the danger zones lie. Now, after running dozens of sensitivity tests, you'll have a mountain of data. How do you summarize it for a busy executive? The answer is the tornado chart. This is arguably the most powerful visualization for communicating risk and value. A tornado chart takes all your sensitivity results and stacks them from largest impact to smallest. It tells the viewer, these are the three things that actually matter for our value. If a variable is at the top of the chart with a long bar, that's where you need to focus your time and energy. It's about moving from everything is important to these specific factors are our key value drivers. Let's examine a typical tornado chart and see what it reveals about a business's priorities. In this chart, we can clearly see the tornado shape. The variables at the top have the longest bars, meaning they cause the largest swings in NPV. Here, gross margin is the king of sensitivities. A small change there impacts our value by $14 million. Revenue growth is second. Notice how things like OPEX growth or CAPEX are at the bottom with much shorter bars. This tells us that even if we are slightly off in our OPEX estimates, it won't break the project. But if we are wrong about our gross margin, the entire investment thesis could collapse. As an analyst, this chart tells you where to focus your research. You should spend 80% of your time verifying those top 2 or 3 variables. That is how you provide truly professional analysis. Next, we must consider the floor of our business, the break-even point. This is the absolute minimum level of activity required for the business to cover all its costs. The logic is straightforward but essential for risk management. We take our total fixed costs and divide them by our contribution margin per unit, which is simply your selling price minus your variable costs. If your fixed costs are $500,000 and each unit sold gives you a $20 margin, you must sell 25,000 units just to reach a profit of 0. This analysis provides a vital sanity check for any new venture. Before you commit capital, you must ask, is it realistic to sell this many units? If the market is only 10,000 units, the project is a guaranteed loss. Never skip this fundamental step in your modeling process. That brings our deep dive into Module 12 to a close. We've journeyed from the conceptual heights of scenario frameworks down to the technical details of Excel data tables, and finally to strategic tools like tornado charts and break-even analysis. Remember, the goal of all this testing is not to predict the future perfectly, but to ensure that your business strategy is resilient enough to handle whatever the future brings. This course is delivered on behalf of the SNB Experts Training Platform, your home for professional finance education. If you found this module helpful, Please subscribe to the SNB Experts channel here on YouTube. We are committed to bringing you the highest quality financial modeling training to help you advance in your career. Thank you so much for your time and focus today. We look forward to seeing you back for Module 13. Until then, goodbye and happy modeling.